Happy Friday, Brian Manning here with your weekly update. So starting Monday this week, we were entering into the fifth straight week of mortgage-backed securities trading in a pretty tight range, which means that we hadn't seen mortgage rates move in about a 5-week period of time. So something was bound to happen, and we did see some movement this week. We'll talk about that in a minute. Tuesday this week, we got Case Schiller Report. Case Schiller measures top 20 markets in the U.S., and appreciation on a year-over-year basis, according to Case Schiller, is up 5.1%. Said this before, kind of think it's a Goldilocks report, and something like this is sustainable on a longer-term basis, so good to see national appreciation still holding tight. Wednesday was Fed Day. Fed had a 2-day meeting. They didn't have a formal press conference, but they issued their announcement, and the announcement they came out was pretty hawkish, causing stocks to rally and hurt mortgage-backed securities a little bit. And they certainly reacted negatively, seeing some negative movement in interest rates. So the Fed left rates unchanged, and they did have some comments in regards to not being as concerned about global economies such as China. They also said that they could see some inflationary pressures here in the future, and they also said they see that job growth has been unchanged. So definitely a market mover, and stocks were happy with what they saw. Thursday this week, we got pending home sales. Pending home sales, we kind of expected. They came out softer than expected, but you're coming on the tail of the prime home buying and selling season, and it's kind of like a double-edged sword. We're seeing that inventories are lower on a lower and national level, and as inventories are lower, that's also causing pending home sales to be a little bit lower. But the double-edged sword, the other side of this, is that we're seeing appreciation hold on a pretty consistent basis. So, there's two different ways to look at that. And then today we got some pretty interesting inflationary information. So first thing we got was PCE. That's personal consumption expenditure. And PCE is the Fed's favorite gauge for measuring inflation. And PCE year over year is at 1.3%, which is not high, and that's not very close to their 2% target. The challenge is that PCE does not take into account housing or healthcare expenses, and I don't really care where you look. Costs of healthcare, deductibles, etc. are going up, and housing costs are going up as well. In addition, we got the CPI, which is the Consumer Pricing Index, and CPI measures changes in the price level of a market basket of consumer goods purchases by a household. So what are we buying, and are those costs going up and down? CPI is up 1.9%. So that's closer to the 2% Fed target rate. But what's really strange is there's a 0.6% gap between the PCE and the CPI. So something's not correlating there. Mortgage rates certainly looking higher towards the end of the week. We're kind of breaking out of this 5-week range where we're at, and we'll have to wait and see what happens next week. They're trying to stabilize right now, and certainly looks like it's doing so in the marketplace. I'm around all weekend. If you have any questions, give me a call. I'd love to be part of your business. Have a great day.